What's up, kiddies? It is Nick and Darren from YieldBoss. Here are 5 major things you guys need to know if you're going to be trading the markets this week. First off, this is a major week for employment and job numbers. You have Jolts coming out tomorrow, ADP, Nonfarm is Wednesday, unemployment claims Thursday, and Nonfarm payrolls, most important, for the previous month of May on Friday. Previous non-farm numbers came in for the month of April at 177K. Our forecast for the month of May is going to be 130K. The market is going to look for a beat on that. Unemployment rate is expected to come in at 4.2% consistently across the board for this month. Remember, Powell's most important and primary 2 objectives is to keep inflation low and the labor market strong. He will not come down from that 4.25% federal funds rate and begin to cut rates until he sees cracks in the labor market.
Next up, Q1 earnings have finished. FactSet has reported that 78% of S&P 500 companies beat EPS estimates above the 5-year average of 77% and the 10-year average of 75%.
Next, the United States Treasury 5-year yield is back at 5%. The last time it was here was October 2023, when the Fed paused rates at the September 20th FOMC meeting and the markets took a nosedive of roughly 10%. This is crucial for firms that are pivoting and diversifying their portfolio multiple years out with the United States Treasuries and other various means of fixed income as the equity markets remain consistently unreliable. And this is why you're seeing the aggressive call buying in the TLT ETF, which tracks bond prices across the 20-year. Next up is the impending announcement on tariffs coming from Trump, which could hit at any moment in time this week. The last time the tariff announcements hit was Liberation Day, in which, as you all know, the market dumped 15% in just a few business days, okay? This is very important because the setup is the exact same as it was last time, with the impending trade balance numbers coming in on Wednesday. And remember, the trade balance is the difference between the value of a country's exports and its imports of goods and services over a specific period of time.
And finally, a review of gamma exposure levels on the SPY. So what we're currently sitting in is we're sitting in a positive gamma regime between 583 and 593. You break over that 593, your biggest magnet is up to 600. Now you break below 583 and you go into a negative gamma regime. And what this will do is it will allow for more slidey movement, more flowy movement, so to speak, down to that 567 magnet.
Heading over to the chart quick, you can see we're in a current accumulation pattern, but we're bumping our head on that 594 supply. There are multiple millions of dollars of calls written, which are sold to open, coming in at that 600 supply level, which is creating a cap for the market, and that is why we're continuing to trade in this range. You can see the volume here is very accumulative as the selling and buying volume is equal on both fronts, and one is not exceeding over another. This is your gap fill that was left over at the end of day on May 9th. And this is where your volume divergence is from selling to buying, okay? Keep an eye on that 565 level because if things go wrong, we are still in your dealer flow window of weakness until non-farm, and you will not see added Vanna and Charm dealers buying back their shorts on the S&P for June OPEX, which is the largest leap OPEX chain that we have currently for the remainder of the year. If we do see bearish price action leading into the middle of the week due to the trade balance news or incoming tariff news that is negative, on top of the fact that Ukraine and Russia are still attacking one another, expect that gap fill and then bullish price action leading into June OPEX.